Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500. That really just continues to be a disappointment here. We had the strongest two-day rally here since COVID right there. Last time we had a two-day performance like this was in the recovery post COVID crash. We discussed that in the SP 500 update on gameoftrades.net that was posted on Friday last week. This is the chart that was highlighted there. You can see that spike in the two-day performance we had, and you can see last time that happened was in 2020. Before that was in 2018, December 2018, 2015, and then you had a cluster of readings right here throughout the 2008 financial crisis, of course being the exception. Right, you can see here in October of 2008, you had this type of two-day performance following the waterfall sell-off here, and then price, of course, continued to move down in the months ahead before really bottoming. Right, a 30% drop after those readings. But if we continue moving back, you can see here in 2002 marked the bottom. Right here, it occurred right during a bear market rally that very quickly reversed and went on to make lower lows. And then in 1998, beautiful bottom and a rally. And yet you can see if we jump over to our Twitter feed, the puts keep on stacking. The SP 500 put call ratio is at levels not seen since COVID-19 and before that 2015, showing a lot of fear in the market. A huge amount of puts relative to the number of calls that there is in the market, and you can see how low that ratio was during the 2021 run, where we were in that euphoric stage of the bull run. Here we're really in that fear range. Now, sentiment tools are not a timing indicator. You can't use them to time the market, although sometimes they do time the market, but it's an indication of what kind of deals you're getting in the market. If people are fearful, you're probably getting better deals than the ones you were getting right here, where the market was very complacent. In fact, you can see when the market was very complacent throughout 2021, you bought here in the short term, stocks went up. But if you look at where we are now, if you had bought in 2021, you'd be at break even right now. So in general, usually not a good idea to be buying when the market is very complacent, even if that means short-term performance will be strong. And this is just our own personal philosophy on the market. And there's a huge number of people that will have different opinions to this. But when the market is fearful, you're probably getting a very good deal on the market, despite the fact that the market could continue lower in the short term. But I want to show you something very specific in this video. This market has been all about the Fed right here. But as we focus too much on the Fed, sometimes we forget some of the most important aspects of the market, and that's exactly what we're going to discuss in this video. By the way, if you're new here, don't forget to smash that subscribe button as hard as you possibly can, and don't forget to click on that like button because it really does help push our videos out to more people. It makes the effort and the time that we put into making these videos, it makes it worthwhile. So those couple of seconds it takes to hit that like button, it is really appreciated. Now, what I wanted to show you in today's video is the manufacturer's new orders. And this is data going back to 1992, and this is data going back to 1992, and you can see, just eyeballing it here, it kind of looks like the stock market, right? It goes up during periods where the stock market went up, it goes down during periods where the stock market went down, and up and down and up until 2007, and down until 2009, down during COVID, and then up during COVID. It kind of looks like the stock market, and you'd be exactly right, because if we take a look at that same blue line, right, the new orders, the manufacturer's new orders here, that blue line, and we track it as a year-on-year percentage change against the stock market, which is in red right here, you'll see they follow each other beautifully. When one is moving down, the other's moving down. When one's moving up, the other is moving up. And again, it's a very, very close relationship. And most importantly, you can see when one is negative, usually the other one is negative too, right? This was the 2000 bear market, where the market obviously moved lower throughout this period. It was in negative territory as a year-on-year percentage change throughout 2001, 2002. And you can see what happened to new orders. We had the same thing. right? New orders were contracting here. This was an economic contraction. And again, in 2008, you can see how similar these two lines look during that bear market. And in 2015, we had a contraction in new orders, and the market went on a brief contraction. Again, in 2018, brief contraction in the stock market and contraction in new orders. And again, during the COVID crash. The main point I want to get to is this gap here, because you can see the stock market in red is in negative territory. We're clearly in negative territory here. And yet goods orders are clearly in positive territory. And we look back to 1994, we don't see anything that looks like that, just eyeballing it. So I wanted to actually take a look at how many times we saw such a big gap between the blue line that's very high and the stock market that's very low. And this is the chart it came up with, right? You can see this is the spread, right, between new orders and the stock market. And you can see evidently here, we have a very large spread, meaning good orders are a lot higher than the stock market, than where the stock market is currently sitting at. And you can see the last time that we had a reading this elevated was actually right here. First of all, we have 2015, 2011, 2010 right there. All of these were major buying opportunities in the market throughout the last 10 years, right? But this is during a bull run. So let's forget about these readings and let's focus on November 2008, March 2003, and December 1994. All of these being moments where we had extremely elevated reading like today. Now let me put a vertical line every time we have this. This is November 2008. This is March 2003 right here, and December 1994 right there. So these are the three moments that look similar in terms of the spread between new orders and the stock market. And all of these coincided with major market bottoms, with the exception of 2008 that came just before the market bottom, which was actually in March of 2009. But still, nonetheless, a pretty attractive 6 to 12 month buying opportunity. Now, the reason this works is really because new orders are a direct representation of how earnings are performing. And we know SP 500 earnings are a big part of the driving force of the market, right? You can see this is what earnings look like over the past 20 years since 2003. This is a straight line, and it kind of looks like the stock market. So basically the stock market goes up and down around the earning. And that's called the valuation. When the valuation is very elevated, it means the market is trading very high relative to its earnings. And when valuations are very low, the market is trading very low relative to where the earnings are. And so you can say this is a measure of valuation. There's lots of ways to measure valuations. PE ratios is probably the most simple one, but we always like to look at things through a different lens to make sure we're not seeing things wrong. And so looking at new orders, which is a leading indicator of earnings against the stock market, is a great way to show you that the correction we've seen has been purely about valuations coming down, but there's really no underlying sign that we are seeing an earnings deterioration. Now, of course, the tightening of monetary policy that we've seen this year that really has driven down S&P 500 valuations, and you can see this is the 1-year yield. We put the stock market on top of this, and you can see this is what really drove the market down. It's been valuation driven as rates rose. That could actually eventually have a big impact on earnings and create something like what we saw in 2008, create something like what we saw in 2000. And that's what a lot of people are saying right now. But the truth is, this chart is telling you that it's way too early to think about that. Seeing goods orders being so elevated here, and you can see the year-on-year growth is still very high relative to any moment in history. We have a lot of room before new orders begin to really contract. We have to look at a huge number of indicators, data that we have to take into account in order to assess where earnings are going, and this is one of them. New orders on durable goods being so positive is not telling me that earnings are about to contract in a massive way. Now again, monetary tightening, could we see a financial collapse in the next couple of years? Why not, right? It's happened before. The Fed is being very aggressive and tightening very quickly without really seeing the impacts, and we're going to feel those impacts maybe a year from now, but until then it seems like earnings remain very strong despite this huge rate increase that we've seen throughout 2022 that again is probably not even really impacting the economy yet. So that's really one of the focus points that we have at Game of Trades. Yes, we pay attention to the Fed. Yes, we pay attention to inflation. If inflation comes down, you're going to see the market rally massively. You're going to see a monstrous rally if you really start to see signs of inflation coming down, which from the work that we're posting on Game of Trades, it seems like that's going to be a likely scenario over the next couple of months. But most importantly, earnings. Earnings are very, very important to look at. And so we are on the lookout to assess where earnings are going next, because a collapse in earnings is what can drive the market lower in a big way, create those types of waterfall sell-offs like we had in 2008 and 2000 or 1969. So our mission is really to bring in a high quality research process along with high quality data, simplify it as much as possible, make it accessible for you guys, funnel it down into a model portfolio, a buy-sell ratings, price targets, making it actionable, and explaining all of it through videos. If you think that's a service that you'd be interested in, make sure to go and check out our website and test out the service for free. Quickly get back to this. This is a fun way of looking at the market right now, looking at how concerned investors are and what they're concerned about. It seems to be a mix of the Fed being very, very aggressive, right? And we know that's been the headwind, and potentially investors trying to front run an earnings decline. This is kind of the market trying to anticipate that earnings are going to move down in a big way, they're going to contract in a big way. Ask yourself, what happens if that doesn't happen? How big of a rally could you get if goods orders actually stay resilient for a few more months? You could have some massive upside surprise, especially if it's accompanied with inflation kind of backing off this macro environment. Just to be very clear, I'm not trying to convince anyone of this thesis. This is the thought process that we have right now based on the data that we're looking at, and it is very different to what a lot of people are saying right now. So make sure you take it for what it's worth. It's an opinion, and also keep in mind that these are monthly dots. Now, why am I saying this? Because a lot of people look at the market day to day. They're going to see this video, they're going to say, oh, you made this as a bullish case for stocks. Why are stocks not rallying today? Why did this week close red? If you're bullish on the market, you know, that's macro for you. You get monthly data, you get slow moving environment. Things don't change day to day. And so what happens in the short term is driven by news, is driven by, you know, price actions, traders, the algos pushing the market in one direction or another. And that's also something that's, you know, very interesting to look at. If we take a look at the RSI, recently had an oversold RSI reading. The last one we had was right here in January at this bottom here. So perhaps we could see a similar setup in the short term to what we saw throughout January, as we saw this big momentum move down, kind of slow down, contract, build a wedge before bouncing higher. We could definitely see that same type of price action, price movement as momentum slows and forms divergence before moving higher. I think that's a reasonable scenario for the market right now. Now, could we see a move straight up here? You know, it's possible. It would need a very positive news catalyst. And we have a CPI number coming out this week. So as we discussed a couple of minutes ago, if the CPI comes in a lot lower than expected, you could see the market recover in a big way, break out through some very important resistance levels very quickly. As investors get optimistic, they think that's going to move, it's going to back off, inflation is behind us. And a lot of those bad news that we priced in throughout the last few months, all of a sudden they get retraced in a big way because earnings are up here while the market is up here. So there's some catching up to do if that bad news that we priced in here starts to clear away. But that would really need that kind of catalyst to trigger that kind of recovery. And of course, we're going to be watching that very closely on gameoftrades.net. If you enjoyed this video, don't forget to smash that like button as hard as you can. And of course, if you haven't already, subscribe to the channel. Now, in the meantime, I wish you good luck on your trading and see you next time.